Market Update October 2022. Equity Market Update. Indian equities rose in line with global indices and Nifty 50. S&P BSE Sensex ended the month with a gain of 5.5 to 6%. Large caps outperformed the mid caps and small caps. The market movement was impacted by sustained buying by DIIs and resumption of buying by FPIs. Expectations of US Fed slowing its pace of rate hikes, rise in global yields, steady corporate earnings growth, etc. Most major sectors barring FMCG delivered positive returns, with banking, capital goods, metals, auto, IT, and oil and gas being the best performing sectors. Most major global equity indices also bounced back sharply after a weak September 2022. FPI flows into equities were flat during the month, as against net selling of $0.9 billion during September 2022. On a cumulative basis, FPIs have sold equity worth $7.7 billion in 7MFY23, compared to being net sellers of $0.6 billion during the same period last year. On the other hand, DIIs bought equity worth $1.1 billion in October 2022 and have cumulatively bought $19.9 billion in 7MFY23. Net inflows to mutual funds in September 2022 stood at approximately INR 17,800 crores and approximately INR 1,29,000 crores in H1 FY23. Of the Q2 FY23 results declared, earnings of banks, IT and industrials were better than expected, while that of NBFCs, pharma, auto, consumer staples and utilities were largely in line with expectations. Results of metals, cement, consumer durables and oil and gas were lower than expectations. Outlook. As on 31st October 2022, Nifty 50 was trading approximately 19.3x FY24 E price to earnings ratio. While the valuation multiples are high compared to its historical average, it should be viewed in context of a resilient economic recovery and healthy corporate earnings outlook. The ratio of India's market cap to GDP is relatively high, at approximately 92%, but within the range of 60 to 100%, in which it has mostly traded over the last decade. The gap between 10Y GSEC and 1Y forward Nifty 50 earning yield is also higher than its long-term average. Moreover, corporate earnings growth is likely to normalize from FY23 onwards. Thus, from most angles, market appears reasonably valued. Moreover, the valuations gap between the current valuation of most sectors have narrowed compared to long-term averages, and valuations for major sectors are close to or higher than long-term averages. In view of the above, while markets hold promise over the medium to long term, one should moderate return expectations in the near term. Outlook for the market is likely to be driven by expected growth in nominal GDP and corporate earnings growth. Optimistic domestic growth outlook, steady corporate profitability, growth supportive policies, etc. bode well for the economy and equity markets over the medium to long term. Accelerated monetary policy tightening, sharp increase in US yields, elevated inflation, slowdown in China, sustained FPIs outflows, etc. are key near-term risks. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.